It's really the emergence of paper currency or the fiat currency as we know it today, which has in some senses resulted in the need for a market for exchanging one currency for the other currency, and hence foreign exchange markets.
As a consumer, I have a choice of spending today versus saving it and spending it a year down the line. If the inflation is high and the interest rate is not high enough, then I know that a year down the line, I'll be able to get lesser value for my 100 rupees versus today. So I'll spend it today. And hence the interest rate has to be higher to incentivize me to save it.
So if US inflation rate is close to 2%, India's inflation rate is close to 5%, the inflation differential of 3% means on an average, we will depreciate by about 3% every year in terms of our exchange value.
Right.
And on 80, 85 or 83 rupees of current exchange value, 3% means 2.5 rupees per year, right? And if you just extrapolate from there, you could potentially be at 100 in about
7-8 years.
Maybe 12, 13 years time, right?
Hi, and welcome to another episode of Open Dialogue. In today's episode, we discuss Forex markets. We will actually take the next few episodes and talk about Forex and the implications that it has on the economy. Joining me today is a veteran in this space, Neeraj Gambhir. Welcome, Neeraj.
Thank you.
Neeraj is the Group Executive and Head of Treasury, Markets and Wholesale Banking Products at Axis Bank. Neeraj has been previously the chairman and currently a board member at FIMDA. He played a critical role in setting up the Clearing Corporation of India. Neeraj was also the vice president of the task force set up by the finance ministry to set up a public debt office in the country. He has played a critical role in India-Japan discussions on cooperation. And previously, Neeraj was an MD at Lehman Brothers and at Nomura in the country. Neeraj, welcome to the show.
Thank you, Samir.
So Neeraj, to get us started, can you just help us understand what is foreign exchange and also provide some perspective on the evolution of this market?
So Samir, let me just take you a little bit down the history lane. It'll be interesting to sort of think about how this entire story of money and story of currency markets evolved, right? The earliest dated use of money in the history of civilization actually predates the written world.
The written world.
Written world.
Okay.
So effectively, we started as a civilization. We started using money almost, I think, 4,000 to 5,000 years ago.
Right.
And over a period of last 4,000 to 5,000 years, different kinds of things have acted as money, as we know it. Starting from, we all know about gold and silver, but bronze, iron. Animal hides, and the most interesting example that I can think of is basically cowrie shells. All of us have heard about cowrie shells, during our childhood days, and there are some Hindi sayings about cowrie shells as well. But cowrie shells have been used as a global form of money for almost 3,000 years now.
Wow.
And that's the longest serving global money till the middle of 20th century.
Right.
It was used as a money in China, in Asia, in Africa, in Oceania, and in India also, we know that fairly well, right? But I think somewhere in the middle of 20th century, I think the earlier part of the 20th century, metals started becoming a form of money. Then gold became predominantly the form of money, and gold coins were being used. And somewhere in the 70s, the form changed once again to become paper money, right? So today's foreign exchange markets are basically a result of the fact that we are using paper money.
Right.
And paper money in each country is different. Every country has its own form of paper money. They use a different sort of word for that money because gold was a gold, cowrie shells were cowrie shells all over the world. But paper money is different in each country, right? And if you think about the fact that countries exchange commodities and services amongst themselves, that's the primary use of money where they need to exchange one country's money against the second country's money.
Yeah. So I mean, if I were to just put this into perspective, so if in India I want to buy something from you, I will give you rupees. So rupee is the way of exchanging, value between you and I. But if you were outside of India, then I need to also place a value on the rupee itself. So there is some kind of exchange happening between us.
Yeah, I mean, just think about this. If you are in United States, rupee is of no value to you.
Absolutely.
Right? You got to spend in dollars. Whatever you want to buy, you need dollars for that, right? So if I need to buy something from you, and my currency is rupee and your currency in dollars, I need to pay you dollars to be able to buy that stuff from you, right? And for me to be able to pay you dollars, I need to first exchange rupees into dollars. And using those dollars, I can then buy stuff from you. The market to exchange rupees into dollars is basically foreign exchange market, right?
And at some point in time, they used to some trader from the Middle East came to India and bought some spices. He would pay us in cowrie shells, and then he would go maybe somewhere else and sell that thing and get paid in cowrie shells. So cowrie shells became the...
Yeah, so I think in that sense, cowrie shells, because they were a very standardized form of beads,
right?
Which were actually, so its history goes to ornaments, right? They were beads. They were liked all over the world as an ornamental value. That's how it started. But then cowrie shells became money in itself, right? But because it is standardized cowrie shells, you didn't need to exchange cowrie shells for something else to be able to buy stuff from other countries. So you could actually have a global, trade just doing a standardized form of money. But it's really the emergence of paper currency or the fiat currency as we know it today, which has in some senses resulted in the need for a market for exchanging one currency for the other currency, and hence foreign exchange markets.
Yeah, great.
Right.
So it gives a very different perspective to, you hear this in Hindi films a lot, right? Do kaudi ka aadmi hai. A very different perspective to the...
Yeah, but remember, though kaudi means its value, right? It's worth something.
Yeah, absolutely, absolutely. So moving on, Neeraj, when I started my career, the rupee was, the rupee dollar exchange rate was, I think, 46. Today it is 83. So obviously kind of the value has moved quite dramatically. So my first question to you is, what determines the value of a currency versus another?
Well, the simplest and easiest way to think about this is effectively currency is nothing but a commodity, right? Why do we need a currency? Of course, we need currency within a country to exchange goods and services amongst each other and a store of value. But when it comes to two countries or exchange between two countries, it's really the demand and supply of one currency versus the other currency, which creates this, this sort of relative demand and supply between the two currencies. So, for example, in India, we are, let's take the example of India and US again. We are importing stuff from US. Let's say we are importing defense equipment from US, right? So we need dollars for that. On the other hand, US is actually importing services from India. There are a lot of KPOs, etc., who are based in India who are providing services to US companies. And when US companies need to pay for that, right, so they need to actually procure rupees for it, and hence there is a demand for rupees and there is a demand for dollars. Now, what outweighs what? Whether you need more dollars or whether we need the outsiders need more rupees determines the exchange value between the two currencies, right? So effectively, what has happened is over a period of time, over the last say 20 odd years, there has been relatively more demand for dollars as compared to demand for rupees, which has led to the value of rupee depreciating against dollar. Right? So, in very simple way to think about this is the cumulative demand surplus that we have for other people's goods, other countries' goods, which has resulted in this rupees exchange rate depreciation. Now, there are several economic theories which go into this, and one of the economic theories is basically to say that if one country has a higher inflation rate as compared to the second country, country A has a higher inflation rate compared to country B, then country A's currency will be basically depreciating over a period of time versus country B. Right? And you know that historically India has had a far higher inflation rate as compared to US. US has historically been around 2%, India has been between 4 to 5%. So one way to think about this is that the inflation difference between the two, which is about 3 to 4%, is the average annual depreciation of rupee that we should expect. And if you cumulate that over a 20-year period, you will come to broadly the same answer, which is to say that rupee should actually halve in value versus US dollars.
Sure. So Neeraj, we'll come to this inflation, Forex, and I think there is also an interest rate angle to
That's
this.
right. That's right.
We'll come to this in a bit. But let's just take the demand supply equation, right? And so when we think of demand supply of dollar versus rupee, there are multiple elements. So there is obviously the trade flow, which is import export. There are also capital flows, which is investment flows, right? Like money coming in for investments or Indians sending money out. So if we take each of these, maybe just helpful to understand like what's happening in India. And so let's start with trade flows, let's say. So what are big components of trade? Are we importing more, exporting more? How has that moved over time?
Yeah, so I think trade flows are the real goods exchange that we do, right? And if you think about this over a period of time, as the Indian economy has actually grown, has become more sort of consumption oriented, more production getting done domestically, we have needed to import certain items which we don't produce domestically. And one of those items is crude oil. Right. Energy needs for the country has grown.
Right.
And we don't produce enough crude domestically, so we've had to import crude oil. And crude oil today becomes the largest component of what we call as our import basket. Right. Then there are a few other things. For example, we also need to import certain equipment which we don't produce locally. Simple example is smartphones. Right. Electronic items. This is another very large component of our imports from rest of the world.
Third one is gold, I think.
Of course, I was coming to that. So the third commodity in some senses in terms of value and that we Indians consume a lot is gold. And we don't produce enough of it domestically, right? So we have to import that. So these are some of the large items that we import. There are obviously a whole bunch of items that we import. In terms of our exports, obviously historically we have been known for our exports of software. I think since I would say mid-90s, over the last about 30 odd years, our software export industry has grown significantly. So that's a large component of export. But what has also happened, and this is something which many people may not know, that over a period of time, we have started importing a lot of items and added value to them and produced something else and then exported that. Two examples. One is gems and jewelry. So we import a lot of raw diamonds, rough cut diamonds. We sort of polish them, we create jewelry out of them, and then we export it, right? That's one example where import for the purpose of export. The second commodity where we have actually started to do a lot of exports is crude oil itself. So today we are actually refining crude oil and then selling outside the refined products, right? So in some senses, the whole contours of, as our integration of our economy with the rest of the world has increased, the contours of what goes into our import basket and what goes into our export basket has actually substantially changed over a period of time. And both imports and exports have grown cumulatively substantially over a period of time. So today, I mean, if you look at it, the total value of imports and exports is almost $1.3 trillion. That's the amount of goods and services we are importing and exporting. That's the real economy part of it. Then we come to the financial economy part of it, the financial side of it. Obviously, outsiders are investing in India and they are basically bringing in dollars to make that investments. Whether they are investing in the companies or they are investing in debt products, there is an external investment that is coming into India. So that's what we call as capital flows. And there is a reverse capital flow as well, in the sense that Indians are also investing abroad. And the third component, which is very, very important for us as a country, is remittances. One of our biggest exporters people, human capital, right? And when people go outside, they take citizenship of other countries, they work for other countries. Whatever savings they have, they actually send it back to the country. Remittances, therefore, are an extremely important part of our, sort of cross-border flows that affect the currency markets in a big way. As I mentioned, that the demand and supply is the ultimate determinant of a value of a currency. And the best way to think of demand and supply is in terms of three components. The first component is what we call as current account. Current account is goods and services that we export and import for the purpose of present consumption. Right? And India has traditionally run a current account deficit, which basically means that we are net importing more as compared to exporting. Right? The second component of this is what is called the capital account. Capital account is the investment and financial related activity, whether it is in the form of debt, equity or any other form. And net we are net importers of capital, which means that more money comes into India, right, as capital flows than what we send out. And in some senses, our deficit on current account gets balanced by the money flows by way of current account.
Capital account.
The capital account. And the difference between the two is what we call as balance of payments balance. Right? External deficit or surplus. So while we are current account deficit, we actually get more inflows in the capital account, and hence in general we are balance of payment surplus. Right? So that's the broad equation as far as the what we call as the external account between India and rest of the
world. And Neeraj, how has this moved? Like the current account, we've always been a current account deficit country, but how has this moved over, let's say, the last 10-15 years? Has the deficit narrowed? Has it broadened? And same on the capital account side, kind of how has that, the nature of that changed?
So it's a very, it's not a very consistent story over a period of time. We used to run a fairly high current account deficit, for example, in 2012, say about 10 years ago, right? Say our current account deficit at one point was almost $80 billion. Over a period of time, that current account deficit has narrowed, but we have had current account deficit move in a very narrow range of say 2 to 3% of GDP. So for example, I would say broadly 1 to 3% of GDP is the range within which our current account deficit has moved. On the flip side, because we are importing capital, because outsiders are investing in the country, we have been a capital surplus. In that sense, capital has been coming into the country, and that number again has varied over a period of time depending upon multiple factors, including attractiveness of India as an investment destination. In general, our capital flows have been higher, and our balance of payment surplus has been about say 30 to 50 to sometimes even 70, $80 billion net surplus.
Understood. Great. So Neeraj, moving on to kind of the other direction that we started speaking about, which is if you look at right now, interest rates in the US have gone up very significantly, almost 500 basis points. India not that much, right? So does this have any impact on the capital flows and hence on the foreign exchange?
So capital flows, you can broadly divide capital flows into two parts, equity and fixed income or debt, right? Equity capital flows are usually very sensitive to the growth prospects of a country, right? Whether a country is doing well economically, there is a lot of growth, so outsiders would want to invest, create capacity, invest capital into this country, and that sort of determines your equity flows. Fixed income flows or debt capital flows are largely driven by relative difference of exchange of interest rates, as well as the credit rating or the credit standing of the country in which the flows are coming in, right? Now, the interest rate differential between India and the next major economy or the largest economy, which is the US, has actually been narrowing over the last, I would say, three odd years. Which basically has meant is that most of the capital flows that have come into the country over the last 2 to 3 years are equity flows. They are not debt flows. In fact, there has been a very, very limited amount of fixed income flows that we have seen, particularly in the last 2 to 3 years, as this interest rate differential has kind of narrowed.
So Neeraj, two questions from here. First is there seems to be a linkage between interest rates, inflation and foreign exchange. So if you can just explain what that is.
Yeah, so I think generally in an economy, the interest rates are a function of the inflation in the economy, right? And I'll again give you an example of recent past. In US, for example, the inflation was very close to zero, less than 2%, but fairly close to zero for a fairly long period of time. Therefore, interest rates in US were also very close to zero for almost like a decade and a half now, since the global financial crisis. India, on the other hand, has had an average inflation rate of about 4 to 5% and actually even higher maybe sometimes.
Correct.
And that is why our interest rates are more close to 6 to 7% as compared to US, where the interest rates were close to 0. So as the inflation goes up, there is a need to compensate the savers more for deferring their consumption, which is that deferment of consumption requires compensation, and that compensation is what the interest rate is.
So just to kind of simplify this further, as a consumer, I have a choice of spending today versus saving it and spending it a year down the line. If the inflation is high and the interest rate is not high enough, then I know that a year down the line, I'll be able to get lesser value for my 100 rupees versus today. So I'll spend it today. And hence the interest rate has to be higher to incentivize me to save it. Yep.
So if I want you to defer your consumption from today to a year down the line, I have to pay you adequate compensation for you to defer it. Otherwise, there's no incentive for you to defer it, right? Yep. And that deferment of consumption is nothing but the interest rates, right? Yep. So this is called a Fisher equation in some senses. Yep. So as the inflation goes up, the need to compensate more increases, and that's what the interest rates are, and hence interest rates are required to be increased, right? Foreign exchange, if you think about this in today's context, it's money, it's currency, right? So therefore, there has to be an element of interest rates into it, right? Interest rate differential between the two countries is nothing but relative differential of deferment of consumption, right? And hence it is also linked to the Forex, the inflation differential, right?
So if I were to again kind of to put it in my words, in the economy, to incentivize me, somebody had to pay me higher interest rate. Now, if I think of myself as a global citizen and I have two quote unquote real interest rates, which means interest rate minus inflation is the real interest rate, right, in some ways. Now, if the US real interest rate is 0 and the Indian interest rate is 2%, then I will put all my money into Indian interest rates, provided the Forex is flat, which means for there not to be any arbitrage opportunity, the rupee has to depreciate by 2%.
That's right.
And hence the differential in real interest rates is a predictor of future depreciation of the...
Well, I would not use the word predictor of,
right.
But in a very mathematical sense, the forward value of rupee or the future value of rupee and the future value, or rather the future value of rupee in terms of dollars should be equal to the interest rate differential between the two countries, right? Otherwise, there is what is called an arbitrage situation,
right?
And you have people coming in and arbitraging between the two countries,
right?
Two currencies, right? So this is what we call as a no arbitrage interest rate differential equation,
right?
Right? In reality, life is a little bit more complex than this. The markets are not perfect, and hence you have situations at times when the forward pricing of a currency is different from the interest rate differential, right? But to come back to your original question, yes, inflation, interest rate, and foreign exchange values are all linked to each other.
Right.
Foreign exchange values in the forwards are determined by the interest rate differential.
Right.
Interest rates themselves are a function of inflation in the economy, and hence by corollary the foreign exchange values are also a function of the inflation in an economy.
Right.
Right.
And also, Neeraj, there is something called this impossible trinity, which places governments and central banks in some dilemma, I think also. So will be helpful to kind of get your...
Yeah, so impossible trinity is basically a notion that you cannot have a open country where there is full convertibility of a currency, have a independent monetary policy, and also have fully market determined exchange rate.
Right.
Right.
So you can't, as a central bank, you can't control all three of them.
All three of them
you
together.
can control two,
you
the third will go haywire.
The third will basically be a determinant of that, right? And the impossible trinity arises when you have basically, you are basically trying to make sure that you have a control over your monetary policy. You are trying to make sure that your currency is well managed and well behaved, right? And you're also trying to sort of at the same time manage the capital flows into the country, right? And therefore, in some senses, you can choose which variables of these you want to manage and which variables you want to let go of. Right? So, for example, if let's take again an example of country and country B. If country A has a very large outflow of capital from its economy, right, the central bank would basically want to manage the currency and not see a lot of volatility in the currency, but there is a capital outflow, right. Now, you cannot therefore manage the currency value, have the capital also freely movable, and also determine the interest rates independently.
So, in this case, you will be forced to raise the interest rate.
Yes.
So that the capital doesn't.
So that capital doesn't flow out.
Right.
So in some senses, the third variable has to be then tinkered with, right?
Right. Or alternatively, you kind of let the capital go out, but the central bank keeps buying dollars. In which case, the inflation will go up because there is just too much supply of.
If you let the capital go out significantly, and you don't have enough reserves to manage the capital outflow, there will be a very sharp depreciation in your currency.
Right.
Right? So you can manage, you can say that, okay, I want to have my interest rates anchored to my domestic conditions. But if you're doing that, if your interest rates are anchored to the domestic conditions and there is a large capital outflow, then you have to let the currency go.
Right.
Right? Then you can't manage the currency at the same time.
Right. Understood. The other question I had on the same topic was, we spoke about capital flows, and capital inflows are of, there is the FPI type of inflow, which is equity markets, and that can be hot money, right? It can come in, go out. And then there is the FDI type of inflow, which is long-term commitment, investment in some plant, machinery or whatever else. How has that changed for the country, and what impact does that have?
Yeah, so I think in some senses you can, if you think about as an investor from outside, you can come into a country and say that I want to set up a plant in the country, and for me to set up a plant in the country, I need to bring in money, and using that money we will buy whatever capital equipment is required, etc., etc. We will pay for workers' wages, we'll set up a company, etc. Now, once you make that investment and you're an equity holder in that kind of a plant, it's not very easy for you to exit it, right? It's not something that you tomorrow decide that I can sell this and get out. Which is why the foreign direct investment of this nature is usually considered to be sticky and longer term.
Right.
Because if you're doing that in a country, you better be sure that you are okay to be there for 5, 7, 10 years time. On the other hand, if there is a market for equities, which is what the stock market is, you can decide to buy a company's shares, exactly the same thing in a slightly different way, and tomorrow if you don't like, you can just sell the shares back.
Right.
And take your money out, right? Which is why the investment in the equity markets, even though effective is the same, you're buying into a company, is considered to be something which people can get in and get out very fast, and hence it is considered to be in some senses hot money, that if tomorrow the market conditions change, people can take their money out. FDI on the other hand is much more longer term.
Fantastic. Last question, Neeraj, for this section is very recently India got included in this JP Morgan bond index. Subsequently, the expectation is that a large number of or large amount of foreign money will come into India to buy bonds. So, what does that mean for Indian currency? And a little clickbaity question to you: does the INR exchange rate get to 100 in the next, let's say, few years?
Well, let me answer the second question first. I think if you think about exchange rate as a function of inflation differential, right, and which is what derives the interest rate differential also over a longer period of time, as long as India's inflation rate stays above, let's say, US inflation rate consistently over a period of time, there is an implied sort of tendency for Indian rupee to depreciate, right?
Provided the interest rates are also like, the real interest rate would kind of determine it more, right, than the inflation.
Well, in some senses, all central banks are looking at their country's inflation rate to set their interest rates.
Okay.
Therefore, I come back to say that ultimately the key economic driver is inflation differential.
Sure. Okay.
I mean, interest rates are a derivative of inflation differential, but the core economic process is the inflation, and the inflation differential is what will drive the exchange values over a period of time. So if you think about this, and that remains to be seen, because we are in a regime change now. US inflation rate after almost 2 decades is now higher or very close to where we are in terms of Indian inflation rate.
It's fascinating,
right? Which is quite fascinating. I don't know whether it continues to be that high, but at some point in time, Fed is able to bring it back to what their historical inflation rate is, which is about 2%. But let's say they are able to bring it down to 2%. So if US inflation rate is close to 2%, India's inflation rate is close to 5%, the inflation differential of 3% means on an average, we will depreciate by about 3% every year in terms of our exchange value.
Right.
And on 80, 85 or 83 rupees of current exchange value, 3% means 2.5 rupees per year, right? And if you just extrapolate from there, you could potentially be at 100 in about
7-8 years.
Maybe 12, 13 years time, right? So over a period of time, if the inflation differential sustains, could we get to 100? Answer is yes.
Right.
But the key question here is what will be the inflation differential between these two economies?
Sure. And on the inclusion in the bond index?
On the bond index, I think it's a phenomenon. A lot of global bond investors follow what is called a passive strategy. There is indices published by some of the index providers, and these investors follow these particular indices. India has so far not been a part of these indices, which is why we haven't seen as much of flow into our fixed income markets as compared to equity markets. Now, as India gets included into these indices, many of these global investors will be required to buy Indian government bonds for them to make sure that they are, passively following those indices, as those indices are, a combination of multiple countries' bonds. So as this inclusion gets underway over a period of next 2.5 years, we should see anywhere close to $25 to $30 billion of foreign capital into Indian bond market. And that's a unique flow, hasn't happened before. Now whether this will lead to a lot of currency appreciation remains to be seen. I think it's, like I said, this is one of the flows. At the end of the day, currency market is a sum total of all the goods, services, capital, all of these flows put together.
Great. Neeraj, thanks a lot for that conversation. Just to kind of summarize all of this, Forex is basically, at the end of the day, it's a commodity. So it's driven by, the value is driven by demand and supply. Demand and supply is driven by trade flows and capital flows. For India, we've been a current account deficit country, we've been a capital account surplus country, and that's kind of determined how the Forex has moved. Also, we spoke about the impossible trinity and the relationship between Forex rates, interest rates, and inflation. And kind of very, very simplistically put, the differential in inflation between two countries should determine the depreciation of the Forex over time, because that then determines the Forex flows. Rupee could very well get to 100 maybe in the next 8-10 years. And there are a bunch of things which will determine this, including the inclusion of the bond market index. Fascinating conversation, Neeraj. Thanks a lot for your time.
Pleasure.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.